Good morning, traders. Chris here with a recap of Tuesday morning's trades. On this particular day, we did three trades. We did a long entry, followed by a short entry, and lastly another short entry. And what we're looking at here on the chart is one of our trend charts. It basically is a clean looking chart. It kind of gives us the overall direction of the market. It's really easy to see. See, we have a new high, next higher low, higher high, higher low, higher high. And then we come down and we actually make a lower low off of a higher high. So I'm starting to see a change of trend here, or something else is going on. We're no longer in that upward trend. We now have a megaphone pattern developing. The megaphone pattern is one of the patterns that suggests that the market is going to make a strong move higher. So when we saw this pattern, this megaphone pattern, we decided to take a long entry, and we actually filled at 95.65, exited at 95.85 for a profit of 20 cents or $200 per contract. So that is the basic setup that we're looking for. First of all, a trend, and then a reason to trade that trend. Here's our Renko chart. This is our primary trading chart. From this chart, we have different strategies that we can trade. We have a couple of different breakout strategies, as well as a couple of different retracement strategies. So here, looking at this chart, first thing we want to do, I always use this dive acronym up here. First thing I have to do before I take any trade is to determine the trend for each trade. Here we have a market moving to the upside, and it comes down, makes a higher low, then it goes up, makes a new high, and you see that little wick right there? We're going to draw down to the bottom of that Renko bar. That's a higher low coming off of a higher high, so we're trending, going off to this next bar, higher high, followed by a higher low. We're still trending, followed by a higher high. So this market is actually trending to the upside at this point. So I'm looking for, obviously, bullish strategies. Then it starts to do this. It starts to break down. And when it breaks down, it goes all the way down here, breaks through that previous low. That is telling me that that upward trend is no longer in effect. Something has changed here. We have a chart pattern that's changed. And what we actually have on the chart here would be a megaphone pattern. If you draw from that high to that high, and from that low to that low, we have a megaphone pattern. And all that is if you draw like this, megaphone patterns are range expansion. You're just looking for the market to make higher highs and lower lows. So if that's a megaphone pattern that is developing here, then we would expect the market to go higher. So in this kind of a chart pattern, I'm actually looking for a pretty good profit, knowing that there's a high probability that the market wants to move higher. And let's go ahead then and look at the actual trade we took in class. Again, D, the first thing of our dive acronym here, is determine trend for each trade. We have a pattern that is telling us the market's going to go higher. So then we need to move on to the I, which is to identify the entry signal. And what we're going to see here in just a moment is a green breakout diamond. This is what we saw in class, and this green breakout diamond, when it comes in with this trend pattern, tells me the market should go higher. So there's the diamond. So we're going to place a buy stop on the current bracket, the upper bracket of the current bar range indicator. Here we have 95.64. With that chart pattern suggesting higher, all we have to do is simply wait for that green diamond to kick in. You saw it flash in and out there. It'll come back in here in just a moment. As soon as I see it the first time, there it is. I put my order there. Now I wait for that breakout to occur. And because this is a megaphone pattern, I'm looking for more than just a few cents here. I'm looking for a pretty good profit, because I'm expecting the market to come up towards a new high, or back up to the previous high at least, if not a new high. So my order's set, and all I do is wait for the market to come and fill me at the predetermined price. Got plenty of time for the trade. I'm not going to sneak up on you. You see it happening, And it's a very simple little strategy. It's all about this breakout, this diamond breakout strategy. It's all about trend, determining the trend for each and every entry. And that's what, again, the acronym here is. The D's determine the trend. I's identify the entry signal, which is right there. And we got our fill. Now, again, I'm looking for more profit here. I got filled at, what was the price? 63. We'll put this at 83 because I only took 20 cents off of it. In reality, what I did is we put the order in at 64. You always tend to get about a penny slippage because it is a market order. So the order's at 64. We got filled at 65. Our exit was actually at 85. For this example here, I'll go ahead and leave it as is. We got filled here at 63. 20 cents higher would be our profit at 83. And the direction of the trend. Verify this setup. In this case, it's just simply a diamond, breakout diamond to the upside with the trend. Very easy setup. And then we execute. The execution is actually consisting of three things. The entry, which we just put at the current bar range indicator. In that particular case, it was at 95.64, so we put it there. And then the exit, put it up where I think it's going to go. Easily should hit 20 cents. And then the trade management, which is simply to use that current bar range indicator. We just continue to follow up, moving the stop, trailing it up on that lower bracket. Very simple, very straightforward. So that's our DIVE acronym. This trade correctly, I have to continue to. Alright, there's our 20 cents on the trade, our exit point. So that was the trade that we did on Tuesday morning. Very easy setup, just a breakout setup to the upside.